given we've got a lot to cover and operating a pretty tight timeline, and go ahead and get started as people continue to join. Good morning and good afternoon, everybody. Welcome to the Abaxx Technologies quarterly project update and Q&A. As this is not a financial release update, and we're still in the process of preparing our audited annual financial statements, I'd like to state up front that we will only be talking broadly about the status of projects, and nothing discussed today should be taken as forward-looking statements or financial guidance outside of our normal course disclosures. I trust that you've all seen our February 1st and February 17th press releases, the Q1 project update and base carbon distribution details respectively, as we'll be primarily referencing those releases. The main objective of the call is to, one, present some plain speak and answer any questions about the spin out and upcoming standalone listing of base carbon shares. Two, to update the status of the Abaxx exchange as we work towards commercial launch, and how we think about the ramp up and 3-year roadmap here. And three, to discuss some of the modifications to our technology rollout strategy as highlighted in our early February press release, and show a sneak peek of our ID++ enabled login and front-end trading platform. After a few brief presentations from the team, we'll open up the call questions from the analysts that have joined us on the line, as well as address some questions that have been emailed in investor relations or in the conference chat. So starting first with base carbon matters, Paris, can you? Thank you. So starting first with base carbon matters, as disclosed in our PR last week, all Abaxx shareholders of record with at least 14 whole shares in Abaxx will receive base carbon shares ahead of the listing in early March. Whether your Abaxx shares were purchased in Canada, the OTC markets in the US, or elsewhere, all shareholders will have the equal right to pro rata distribution. The shareholder record date is the close of business on March 1st. And again, we will be distributing one share of base carbon for every 14 whole shares owned in Abaxx. The Abaxx improved this ratio from the original 1 for 15, as we wanted to distribute at least 5 million shares of base, just over 20% of our total holding, directly to shareholders. We will talk about the long-term financial implications of the base carbon development, but I believe this was actually a transformational development in the company's history, and we wanted to share this early success with our long-term supportive shareholders directly. I also want to point out that anyone that plans to buy or sell Abaxx shares ahead of the March 1st record date this week, trades will likely need to be placed this week by close of trading on Friday, given the trading settlement time to have shares registered on that March 1st record date. So again, I've got a couple bullet points up on the screen, and we can answer more in Q&A. But I want to reiterate to all shareholders will be treated equally, no matter where you hold your shares. And for those that trade Abaxx OTC markets on the OTC markets listing in the US, my understanding is that base carbon does plan to apply for an OTC QB listing and ticker, and normally that process can take up to 8 to 12 weeks. This is a new listing, base carbon, unlike the NML transaction where Abaxx went public, where there was already an existing US listing. So there may be a lag, and I'm not an expert on DTC protocols, pink sheets or other ways to trade immediately, but all intentions are for the listing to happen as quickly as possible in the US, as well as the what looks like will be a March 3rd listing on the NEO in Canada. But I should reiterate that this is solely a base carbon corporate matter, and base carbon shareholders should rely on the disclosures and guidance of base carbon management after March 1st. So turning to the update on the exchange and our 3-year plan update. For this section, I could probably present for an hour or more, given the scale and complexity of our projects and ambitions. But I think it's easier to answer a lot of this in the Q&A. That said, I do want to give you a framework on how we are thinking about the launch, ramp up, and opportunity, as there's been a lot of investor questions on the timelines, and I want to improve the company's communications regarding the stages and the steps. In hindsight, it seems that the format of some of the regulatory filing milestones could have been clarified with some of the comments and explanations I've given in presentations and quarterly project updates. The launch of a major market infrastructure project isn't as linear as the launch of, say, a retail trading platform or an e-commerce website, for example. We are quite reliant on the timelines of some of our clearinghouse partners and the iterative process with final regulatory approval based on the combined final work with our partners. Developing the commercial environment for market liquidity in a physical futures product will happen concurrently with our efforts, working with our commercial market participants to place block trades and start moving some of their forward bilateral trading book, their individual spot market trading with each other onto a cleared exchange. So establishing the commercial use of our markets is a multi-year process in developing a curve of delivery cycles. This is very different than just trying to ramp up maximum trading volume in a cash-settled futures instrument, for example. This multi-year investment is well worth it in our view, though. As I think I mentioned in a tweet thread, on how I think about the valuation and capitalization last month, we're prepared to spend another 3 to 4 years to keep investing and establish these markets. David Greeley will be sharing some slides just after I finish here to show some of the ramp up in total addressable market potential that we're going after in the 3 core markets we've outlined specifically. So keeping that multi-year investment in mind, in my opinion, investors have perhaps overlooked some of just how important a successful spin out of Base Carbon is for our balance sheet long term, and our ability to invest in this potential while limiting funding dilution or giving us overall financing flexibility. As per our latest Q3 financials, we had roughly 30 million in net cash and saleable assets on our balance sheet. We maintain a pretty consistent 1 million CAD per month in expenditures outside of extraordinary items related to the financings we undertook in 2021, and that should increase by about 20 to 25%, call it $1 million per month as we move to the commercial operation this year. So setting aside 10 million in regulatory capital, we had about a year and a half of runway to build the LNG forward curve into mid 2023 regardless. But now the base carbon equity on our balance sheet also gives us another year or two of ramp up towards the potential we believe we have in this market. So again, more than doubling our view of our runway. Further, once the market has visibility on our product ramp ups and the ramp up of base carbon projects into next year, and therefore our base carbon royalties starting, we believe we have a lot of financing flexibility and forward NPV in our businesses. So again, I can't stress enough just how important it was that we've been successful in base carbon development, for the next 3 years. So finally, before handing over the presentation, I also wanted to briefly update shareholders on our technology roadmap and strategy. Probably the most important technology update we gave at the end of January was that we now plan to commercialize Abaxx technology software suite bundled together with the launch of the Abaxx exchange and derivative trading platform, forgoing our previous 2-phase rollout where we would initially launch just a third-party GUI and ISV-based trading system where most of our trading clients would connect through their own trading systems remotely. And now we will be rolling out a more advanced product suite integration, including our proprietary front-end trade order management, which will give a very quick sneak peek in this presentation. Importantly, the software suite includes new tools for the LNG industry to calculate and bundle voluntary carbon offsets in bilateral or derivative exchange for physical trades, as well as a blockchain time-stamped and documented ESG data capture. So this really fulfills our vision of ESG commodities and where we believe we can be leaders given our technology stack. Ian will be giving a sneak peek of our ID++, Web3 native integrated platform in just a few minutes. But I'd like to highlight for a second the importance of this technology roadmap adjustment and how it will become a bigger part of our product pitch and influence our commercial rollout over the coming months. While we believe our approach to technology could really start to disrupt our whole industry over the medium term, hence why we built Abaxx Technologies the way we did in the first place, we had also taken the conservative approach of launching a plain vanilla system to start and only layer in new software tools later. This is the so-called windows and floor mats approach to selling our products, where the technology is just the ancillary features. However, we probably downplayed just how important it is to be Web3 native in our tech stack, something no other commodity exchange and clearinghouse is in the energy space. In fact, our competitors have just now announced major big Web2 platform partnerships and migrations, taking the leap where we were already natives in our tech stack build. But we believe that our jump to Web3 will enable us to move to real-time collateral movement and clearing well before other clearinghouses, giving our clearinghouse and our clients significant capital efficiencies and risk management without some of the collateral risk charges that comes from multi-day and multi-period settlement. So we'll be placing increasing emphasis on our technology in this final push with our commercial clients, a real differentiator in the industry. While T+0 on collateral will not be ready on day one, mostly because of the risk systems used and the technology in the firms that connect to us. But our approach to embedding the technology natively with ID++ and our user management and user key signature systems will allow it to be turned on incrementally, and therefore far easier than changing a live trading system later, as many firms will need to match us eventually. Again, we can cover some of this more in the Q&A and perhaps make sense of all of that after the demo. And so with that, I'd like to turn the presentation over to David Greeley, our chief economist, to run through the addressable market opportunity for the first products we'll be launching.
Thanks, Josh. As Josh has said, I'd like to share some of our thinking on market opportunities. Everything for us begins with the commercial needs of the market. In particular, the exchange volumes that we would expect are driven by those commercial needs. When we look across futures contracts and futures markets historically, what we tend to see is that the success of a futures market, the success of the contract, and the size of the volumes is really driven by things like the physical market in terms of the size. Are there price risks that are worth hedging in terms of the volatility of prices, and the physical investment needs and the growth of the market? And when we look at the futures and options volumes, they tend to layer on top of the physical market. So the amount of futures volumes that you expect, volumes on the exchange, tend to be multiples of the underlying physical market, with the liquidity tending to collect and pool in the primary benchmark. So when you look across the futures markets, you tend to see one contract dominate, whether it's Henry Hub natural gas for US gas, WTI and perhaps Brent in the oil market, LME copper. You tend to see one contract where the liquidity tends to pool. And the physically settled contracts are the gold standards for those primary benchmark futures contracts. When you look across different exchanges, what you tend to see is that the futures volumes on those primary contracts tend to trade, like their multiple tends to be a range, something like anywhere from 20 to 60, but most clustering somewhere around 40. So about 40 times the size of the underlying physical demand. And then the exchange gains additional volumes from secondary or basis contracts. So for example, in the LNG market, perhaps trading Henry Hub gas or TTF gas against an Abaxx contract that allows the participant to be able to conserve on margin by netting. So the exchange not only has the volumes on the primary contract, but on these differential and basis contracts. These contracts, which we would introduce, are normally cash settled, and they'll tend to run something like maybe 10% of the futures volume in the primary contract. And then as the futures markets grow, those options markets develop as well, and they add additional options volumes to the exchange, often on the order of about 20%. So all in, the total volumes that the exchange sees is often on the order of 50, 55 times the underlying physical market. And when we look at the three major markets that we're looking to list contracts on: LNG, carbon, and the gold markets. If you can move to the next slide, Paris. We believe that all three of these markets, LNG, carbon, and gold, have large, unmet, or underserved needs. So we did put together some numbers to give you a sense of the size of the market opportunities that we see. We used 2030 numbers to get a feel for what is the total addressable market in our exchange product pipeline if you're looking out, say, to 2030. Now, starting with the flagship product, global LNG, the physical market, looking from the Morgan Stanley numbers, they're projecting something like 540 million tons per year. If the short-term and physical trade in LNG was about 60% of that, that would give you a physical market basis of about 320 million tons per annum. At $10 an MMBTU, that would create a physical market size of about $150 billion per year. If we looked at the total, that's probably a conservative number. If you looked at the total LNG market under that estimate, that would be closer to $250 billion a year, which is on the order of the size of the copper market. Translating, that 320 million tons per annum physical market, that would likely support futures and options volumes for the exchange of around 310,000 average daily volume in terms of a potential total addressable market. And to put that in context, if you look at futures and options on the CME natural gas contract, so the physically delivered Henry Hub contract, that alone traded about 485,000 average daily volume in 2021. So a large opportunity available there. Moving on to the carbon markets, when we look at the carbon opportunity, I'm sure you've seen with the Carney Task Force report, they're estimating a voluntary carbon market of somewhere between 1 and 2 billion tons per annum by 2030. If we take the midpoint of that, 1.5 billion tons per annum, and at $100 a ton, that would translate into 150 billion a year market, comparable to what we would be seeing in LNG. That might be a little optimistic. That's the number that is consistent with what you've heard from the task force and Mark Carney. But even at a $50 a ton price, that would still be a 75 billion a year market. And regardless of the price, that 1.5 billion ton per annum physical market, applying the multiple that we discussed, would translate into a potential total addressable market of 310,000 average daily volume. So once again, large potential volumes for the exchange. If you look at that, to put it in context, ICE reported that in 2021, across the compliance markets, it traded 18.3 billion tons of carbon allowances, which is equivalent to about 73,000 average daily volume. So we would be expecting, as everyone does, strong growth in the carbon markets over the next decade. Moving on to the gold market, whereas the LNG and the carbon markets are, growing and young, the gold market is a more established market. Current physical trade is about 4,500 tons per annum. Could expect that to grow to about 5,000 by 2030. And if prices hold around $2,000 an ounce, that would be a 320 billion a year market, with a potential total addressable market of 334,000 average daily volume. And to put that in context, the CME physically delivered gold contract alone traded about 265,000 average daily volume last year. So across all those markets, what you see is about 300,000 plus average daily volumes of the total addressable market that could potentially go to the exchange. And I think what you see is large unmet commercial needs that create large opportunities for Abaxx. Now, as we turn to the next slide, of course, what we see is that it takes time to realize these full opportunities. And I think the experience of the iron ore market provides a good case study. What we show in the slides on the right from S&P Global Platts is the development of futures and options volumes on the iron ore exchanges. So the Singapore Exchange introduced iron ore swaps in 2009 and its first iron ore contract, futures contract, in 2013. And you can see it took some time for the volumes to pick up. And arguably, depending on whether you count from the beginning of the swaps to the introduction of the futures contract, you probably reached a mature market size around 2016. So something like 3 to 7 years for that market to mature. The Dalian Commodity Exchange launched its own iron ore futures contract in 2013. And of course, that ramped up much more quickly, likely reaching full maturity within about 3 years. And that's consistent with what we've seen across other markets, in that it's quicker to take market share than to grow market. You've seen that with the migration of volumes from the UK MBP contract in European gas to TTF. And you've seen it with the switch over the decades of volumes from WTI to Brent. But either way, capturing large opportunities is a multi-year process, but we believe those opportunities are large and we're well positioned to capture them. And with that, I'll turn it back to Josh and Ian.
Thanks, Dave. Again, we're hopping a little bit around, but I want to introduce our new head of product, Ian Forster, to walk through a little bit on ID++ before we can answer some of the technology stack questions in the Q&A.
Thanks, Josh. So I wanted to give a brief intro of ID++ and why we think it's important to the development of the exchange. What you see on the screen here is the way that most web applications sort of currently exist. And you can see that in this system, we're really relying on the applications we use to custody our data. That includes whatever content we generate, messages that we send or receive, and all the files that we upload, including the personal data that we use to verify our identities. And this model really introduces risk for all sides. Developers bear the cost and liability of protecting our data and incur a large security and storage expense for data that likely already exists somewhere else online. Now, these costs have compelled tech companies to monetize the data in their care, leading to a misalignment of incentives in their relationships with users. And I think we're all at this point familiar with the aphorism, if the service is free, you're the product, not yet Paris. Even with the best security, at some point, every platform is compromised. Multiple incidents from SolarWinds in 2020 to the NSA hack in 2016 have shown the fundamental vulnerability of centralized data stores. It's not a matter of if a hack will happen, it's when. And the targets keep growing as users create a horde of fragmented identities on servers all over the world, each new account building an ever-expanding attack surface for bad actors. Now, given that the risks are so poorly understood and our options are so limited, the choice for most of us is to either hold our nose while we click accept on a privacy policy, or to turn a blind eye to the whole situation as if to say, this is fine. Well, we didn't think so. As part of our commitment to build an exchange that serves market participants with smarter tools to manage risk, we thought we could do better, so we built ID++. Now, ID++ is an open source, decentralized identity protocol designed by Abaxx to put you in control of your own data. Personal or company data, including W3C compliant verified credentials, are custodied by the user in a cryptographically secure digital wallet stored on a blockchain. And when an application needs to see that data, they just ask. We've built ID++ right into the foundation of Abaxx Exchange with tools for identity and access management, private messaging, secure storage, and document signing available to firms who want to reduce counterparty and compliance risk and streamline their back office for smoother bilateral trades. So with that, we put together a brief video that shows our products as they exist now and shows some of the integration with ID++ and how this model translates into a real world use case. So.
To log in to Abaxx Exchange, I use Abaxx Verifier to scan the QR code visible on the login page. Verifier is a unique identity and access management application built to work with ID++, the decentralized identity protocol that powers the Abaxx ecosystem. Verifier allows me to authenticate the verified credential issued by my institution with biometric security features found locally on my mobile device, providing convenient access that is more secure than username and password. Once logged in, I navigate to the Trade Entry home screen. Trade entry is where pre-negotiated trades of futures and physical cargoes are recorded and settled, and provides market participants with a number of different strategies for bilateral trades, EFRPs, and block trades, plus tools to calculate and offset the total GHG emissions associated with physical cargoes traded on the platform. Our Ghg Calculator allows buyers and sellers to quickly calculate the carbon content of their cargo. Using data gathered from global liquefaction, regasification, and shipping providers, buyers and sellers can quickly calculate the environmental impact of their cargo and bundle the right amount of carbon offsets with their trade. At Abaxx, we're committed to building a commodities exchange for the 21st century and beyond, with convenient tools to manage risk for all market participants.
Thank you, Ian. So with that, I want to turn this over to the Q&A. I've also included our Chief Commercial Officer, Joe Rea. Again, Ian and David will join us, as well as Base Carbon CEO, Michael Costa. So I guess with that, I'm going to turn it over to questions. So the analysts on the call, please feel free to unmute, and we can jump into the Q&A.
Hey, Josh, this is James. Can you hear me?
Yes. Hi, James.
Hey, I hope I don't. First off, it's an honor and a privilege to be on the call, and I really appreciate you inviting me today. First question, I didn't anticipate asking this, but would you mind providing some color on the timelines for the launch of the exchange, and what challenges you have been faced with, and how you're kind of working to overcome those and launch as soon as possible?
Thanks, James. Yeah, no, I appreciate it. I figured that was going to be the focus of a lot of the questions in call. So again, that's why I wanted to start off and reiterate this is a multi-year build, regardless on whenever that first trade date is, and that's what we're investing towards, and we wanted to set those expectations for our shareholders. But that said, I have recognized in some recent questions, that have come in around some of the confusion on the timelines and the steps. One of the things that was probably a little bit unfortunate, and I think we talked about this, middle of late last year, is we are very much sort of captive to some of the timelines of the integrations of our FCMs and sort of financial market infrastructure partners. And as anyone that's worked on IT integrations with a major bank, there's really timelines and windows of opportunity to get some of that long lead time process moving. And so unfortunately, particularly given some of the COVID delays in sort of just overall global documentation and call it bureaucratic processes, we missed the window last summer, because when we expected an approval in principle kind of in the spring, when that pushed to fall, unfortunately it kind of left us with some problematic timelines to get some of that process moving at the end of the year, right? Particularly when you're talking about IT budgets and both of that time allocations as well as allocations of the partners. So we didn't miss a window. So we've been pushing much harder, really since day one of January to get back in people's timelines and priority scheduling. And we've had some very important developments with FCMs in January. But this is an ongoing process. I will say that really March and April in particular are huge commercial months for us. We have Joe and Dave will be headed over to London to see all the major banks again next week, and then we launch into Sarah Week in Houston, as well as we're a major sponsor of the FT Global Commodities Summit this year in Switzerland in mid-March. So although I don't have specific updates at this time, because I really want to spend these the next 4 weeks in our heavy commercial engagement. I think we'll be able to discuss the commercial updates at that time. But that said, the other question that I think has been raised is around the regulatory process. So really, the key, the lift, the multi-year lift on the regulatory process was really where we got our approvals and principles from the Monetary Authority of Singapore. So that is largely behind us. Now, I don't want to minimize, what's left in the regulatory process, because obviously, we're not going to be launching until everybody is ready, to handle the risks of these markets. But that said, it really is a little bit more in the control, the final timeline. So this isn't, these last steps are not necessarily a wild card of getting through, committees. It really is about, just working with our FCMs and our members and finalizing that last, call it 5% and taking down the license when everything's ready. So it's not, what was presented perhaps as this linear timeline of, we'll take down the licenses and then we'll launch the exchange. Yeah, I mean, we shouldn't be expecting, until we're very close to launch, we shouldn't be expecting the regulatory licenses, announcement. So I just wanted to explain that process a little more and give you more updates on the commercials in a month or so ahead.
Yeah, it sounds like it'll be a very exciting March in April ahead of us. I have just a few questions around the base shares. In Q3, it was reported that there were 21.5 million base shares at an average price of 215,000. Looks like there were 2.9 million shares added in December. Were those bought in the bought deal?
That's correct. Yes. So we did end up participating. Abaxx came in for I forget the exact percentage, about 7% of the offering. So you're correct. Just under 3 million were purchased in the offering.
So I think the total percentage stands at like 19.7%. That is the percentage that Abaxx owns of base. Since that's below 20%, does the equity accounting method still apply at the end of Q4, or are you going to be looking to mark on base shares?
Thanks. That's a good question. And again, I want to try to avoid too much financial guidance, but it is complicated. It is complicated, as you understand. So, technically, the under 19.9%, you're absolutely right. That could be considered equity accounting, particularly given the path to go public and a liquid mark to market. But that said, there are tests for control, even if you are below 19.9. And so, it's still, we do have to work through with our auditors over the next month, particularly after base trading starts trading, whether we'll finalize to the equity method or mark to market. So, but regardless, within quarters ahead, that it would make, particularly as we drop our overall through the distribution, it will, at some point we will realize that mark to market.
Okay, excellent. And a larger picture, stepping back, exchange clearinghouse. Can you describe why owning a full stack exchange, particularly a clearinghouse, provides optionality for Abaxx to respond to customer demand for new contracts?
Yeah, absolutely. I mean, again, having this sort of full stack in our control, allows, I mean, Joe can speak to this much better, and all of the thousands of products that he listed, once the Clearport product was live. But really, it comes down to two things: is really just controlling that full supply chain, we'd call it, regulatory supply chain from the product development with the customers to the risk management and the regulatory reviews, as well as the FCM collaboration. So you can imagine that if you are only operating an exchange and you are partnered with a third-party clearinghouse, some of that direct connectivity to the FCMs and the regulatory processes could take much longer. So this will allow us to move quickly and control that whole process. The marginal efforts to launching the next products are so much less than getting the whole ecosystem off the ground. Joe, do you want to add anything to that?
Yeah, I mean, you hit, thanks, Josh. Nice to see you, James. I think you hit the nail on the head. It's just really important to know that the interaction with the marketplace, which we feel we have a leg up on the incumbents, will bring new product ideas, and having the clearinghouse and controlling our own clearinghouse will give us the opportunity to list products and really test the waters on new ideas and technology linked to new products that really have yet been done by the incumbent exchanges. So I think it's a great opportunity for us to do that.
Yeah, and just real quick, it seems to me that the paired LNG contract is really quite intriguing. And if you go back to like the first interview by Robert Friedland on Smarter Markets, he talks about the potential for verticals within each commodity sector, and the potential for an oil and gas vertical seems like it would be a good match. If you're doing a paired LNG contract, is it possible to do a paired crude contract? So it's kind of like a green crude product.
Yeah, absolutely. I mean, look, I think the first step, you really don't want to fragment liquidity in current products. So, particularly when you're talking about LNG, the first step is actually establishing, the most, broadly accepted make or take, delivery market, so that you have the most supply and most demand, sorting out those prices. So that's really the first, is to find that benchmark. And then you can look at, whether it's through other futures basis contracts, for location or quality or other basis. You can look to do that, but really the first step is actually finding and registering that data even in physical markets. And that's why we focus so much on how the process and the ability at the delivery cycle and the delivery window to bundle both carbon data as well as potentially carbon offsets, really will increase the transparency of this market, and a end demand that wants to know, for certain, that and all the stakeholders want to know, if in fact, these are good quality offsets, and, rather than just relying on a press release, you know that a carbon neutral trade went through a regulated exchange. We think that increases the trust and transparency of this market. And yes, so long term, we are looking at that vision of Robert Friedland, and obviously, the vision that we started with this, where you can bring new technology as well as new benchmarks to manage the energy transition, which will increase capital and the ability to put capital in this market and grow these markets, but also add transparency in ESG data, which I think, at this point, it's becoming pretty unanimous that that's where the industry is headed.
Thanks, Josh and Joe.
I'm sure, James, you could have 1,000 questions. So
I'm good for now. Thank you so much for your time. Appreciate it.
And we'll, obviously, we'll keep the floor open until the top of the hour.
Hey, Josh, it's Steve Boland.
Hi, Steve.
I'm just wondering, when I look at the projections now going out for 7 years that was provided earlier, especially on the LNG, I'm just wondering, is that infrastructure, I know had been, that had begun years ago in terms of signing up, whether it was, traders, whether it was, companies that had the ability to deliver or receive LNG. Can you just give an update on that? Like, in terms of, some of these customers have been waiting, I think, for a few years now. I mean, has there been any churn? And then do you have the potential or the if there is a big demand for physical delivery, is that infrastructure in place or is it still ongoing?
Yeah, no, great question. And one thing I would also say is just, from the beginning of this process, when we were kind of taking a leap of faith, there was, probably in 2018, 2019, there's probably a decent part of the market that just didn't fully buy the spot market narrative, that it could have its own benchmark. People were still talking about long-term oil indexation. I'd say what's happened over the years is I guess we've been proven right by the market and the way it's developing. And what was like a question of whether our product was needed 3 years ago, I think all of that doubt or those questions have really been removed at this point. Particularly given the pre-winter storage months and sort of the price spikes and sort of the lack of market coordination in buyer and seller of last resort markets in Europe and Asia last fall. And every projection that I've seen is that will continue. So better organization is definitely needed in the market. Now, that all said, I'd say the biggest turnover is within the firms themselves. Every firm is ramping up both LNG and carbon trading desks, where some of them were maybe focused more on long-term commercial type sales. There's more and more trading desks, and people may be on their third firm since we started this process because there's so many jumping around given the opportunity of trading LNG. So again, this market is developing and robust along the curve that we believe all commodities do. And I'd say, if that accelerated in the last year with LNG, the carbon market is even crazier, right? And so, both these markets are really gearing up to where the sweet spot is for a product like ours. Joe, anything else you want to add there?
I would just say on 2 points that the terminals are existing, so there's no issue from a delivery perspective for our contracts in the regions that we will be listing them. So we have a lot of full confidence in that. I think the other thing is that we keep hearing from the marketplace now 3 years on is that there still is no definitive way for commercial firms to mark their books better with a financially set up product versus a physical product. And the market still needs it. And that's really what we keep hearing day in and day out, as recently as this week, as recently as last week. I mean, when we talk to commercial firms, that's one of the biggest things that they say is needed in the marketplace in physical LNG. And certainly as we start adding carbon associated trades to that, it'll be the same issue. So we know that the marketplace, the incumbents haven't addressed the issue. We think we have the ear of the commercial firms and the trading firms, and we're going to execute on it and bring them what they want.
Great.
I think there's also been a sense of inevitability in many ways where, again, maybe 2 years ago, people were wondering, okay, we know all of the cast of characters within Abaxx from, former business cards. So, we never had, credibility getting in the door. But the big question is, are you here for the long term? Are you here to stay? And I think our go public, the fact that we've been engaged with these clients for, some almost 3 years, I think people realize we're not going away. And we're in this to build a very tricky and difficult physical market over the long term.
Okay. And just one more, Josh, just remind me, the actual ownership of the exchange, has that been finalized in terms of what you're keeping and what your trading partners are taking? Is that structure been finalized?
That's a great question. So we have been increasing as we fund the ongoing operation of the exchange. We have been increasing our equity ownership in it. So we're well over 90% now at this point. Now we've left our financing open. Whether we finance from the parent company, public company level, or if we want to bring banks and major energy companies into the actual equity of the exchange. So we wanted to keep that option open until really the point of launch. To be honest, it's still it's a very different market than it was a couple decades ago when ICE launched and gave away a large portion of the exchange to member firms. It's just a very different market from a risk and and how companies manage risk on their balance sheet. So, particularly after Dodd-Frank, so the ownership of a clearinghouse is a little bit of a different situation than it was, before 2008. So, that said, we're still, there are a number of our key, large constituents that would like ownership in the business. And so we're really just managing that, where we have access to capital through Abaxx shares, of course. We have access to capital if we decided we wanted to, sell base shares down the road after that business is developed. And we have an ability to sell directly at the exchange level to strategic partners. So all three of those will be on the table. But again, we won't likely need it over the next year. But we want to just increase the optionality of financing. That was the main step of the structure. And if we do sell part of the exchange directly to strategic partners, and it would only be to strategic partners for that matter, we of course keep a royalty over the top of it, so that Abaxx Tech shareholders always have that long-term royalty exposure.
Okay, thanks. I'll pass it on, Josh.
Thank you. I guess, again, you're obviously going to ask more questions, but I also wanted to mention that Michael Costa, the CEO of Base Carbon, is also on the line.
Hey, Michael, there's a lot of U.S. shareholders of Abaxx Tech. Would you be able to provide some color on what will happen for the distribution of their shares? I'm assuming that we're waiting on like an OTC filing or ADR for Base.
Yeah, I think that from an Abaxx standpoint, what happens.
Oh, Michael, we can barely hear you, or maybe it's just me, but your microphone.
1 second, guys. 1 second. Is that better, everyone?
A little bit, yeah.
And to address the question, I think that there's two parts. I think relative to the distribution from what quote unquote happens to U.S.-based shareholders, I think that really that happens as they feel as a portfolio. That part's really appropriate for me.
Michael, I don't know if it's me, but I still can barely hear you.
I'm having difficulty making Michael out.
Yeah, same.
I'm sorry, everyone. 1 second.
Okay. So I'm no expert on this, but maybe I'll start as Michael gets adjusted there. It really is in the weeds of the DTC and CDS sort of systems. So Canadian deposited shares, even if it's a U.S. broker that uses a Canadian depository, will have their shares instantly on March 3rd. The question is there will be sort of a back and forth between DTC and the transfer agent, for those that aren't operating in the CDS system. So again, that remains to be seen on the timeline, but also there is the timeline of the listing of the OTC markets, ticker in the U.S.
Great, thank you, Josh. I don't want to take away from anybody else's questions, but if nobody else is going to ask something, I'll pick up a few more here. So one of the criticisms that I frequently hear is that, why can't Singapore Exchange or CME or ICE basically replicate the contract that you're trying to create with LNG? Can you speak to that as to what the strategic advantage is that Abaxx has in that market?
Well, I think it's just our approach, and so again, there's nothing per se, that stops them, and I don't want to, give that guidance that maybe they aren't working on other products, but I think our physical approach, both with the FCMs and the commercial users, is perhaps maybe we're taking a different risk, a different long cycle risk to develop a far more tricky product than say a cash settled index product. And so and we've seen this in many markets. Even I hate to use the example, but even something like Bitcoin, right? It was a cash settled index market first, and eventually a physically delivered product came later. So there's a number of examples like this out there. And look, and not all commodities end up with a physical product. I mean, you look at the battery metals as well, where those are almost all index type products, where whether it's a financial publication or other data providers providing an index of which a derivative sort of bet settles against. So our understanding right now is that we are the only ones taking the specific approach we're taking, and really it's the risk reward of getting that right. Joe, anything else you want to add there?
And I think you addressed it, Josh. I think that we know from the marketplace that again, our interactions with the trading firms and the participants in LNG right now, and even in carbon, are telling us what they want, and we're addressing that. And I think that just from myself and others that are on our team experience with working at exchanges, we know how they pivoted from the physical model to the financial model, mainly because they're easier to launch. They want to generate data revenue quicker. They get them out the door. They're obviously all things that we want to do too, but we think that there's an untapped demand for physical markets. And I go back to my earlier comments and what we heard from the marketplace about that specific need to do a better job of mark to market and managing risk on their books with physical products rather than index products. Index products are just not the answer for these firms for risk management. And that's really, I think, what the main point that the existing exchanges are missing.
Thanks, Joe. Thanks, Josh. I appreciate that. That helps answer the question, I think, in my mind. Kind of pivoting to the tech, one of the questions that I kind of get every now and then from shareholders that I would like you guys to answer is where is the tech team kind of standing right now as far as like headcount? How many developers do you have on the tech, and how many are you looking to hire over the course of the next year? What are they currently working on?
Yeah, so it's consistently run at about a third to 40% of our company, and so but it's tricky because we use a mix, given the nature of multiple products, both the tech infrastructure, the software tools. We've also used a number of agencies outside of the firm to develop some of the design and some of the front end. So that's sort of constantly in flux, developing on where we are on various sprints. But from a full-time perspective, focused only in Abaxx, I know it's usually running about 30 or 40% of our overall headcount.
And as far as the timeline for the software launch, is that kind of going to mirror the launch of the exchange and then commercial launch of various applications thereafter, or what are you thinking around that?
Yeah, so I think that's the major development, where we were thinking that we would launch, again, a very back-end infrastructure heavy, exchange only, from a software infrastructure perspective, but we'll bring our own front-end tools later. But I think what we've decided to do is, as we've completed more and more of the front-end tools, is to really give that whole console, opportunity to clients up front. Which, by the way, they could even trade over the counter using our software in bilateral trades, even without having our regulated futures market. And this would just really be using our software to manage the workflow of trades, as well as the carbon calculator and market access to spot carbon markets for trade bundling. So we do to plan to launch a number of our software products, call it first in many ways. Where the commercials sit on that timeline is still, again, our next commercial push over the next 4 to 6 weeks is going to be important to answering that question. I will say, the ID++, the tool that you saw, logging in, I guess, now that we're kind of in that, getting commercial ready phase in that, what we realize just how powerful that infrastructure is. Not only some of the sort of behind the scenes issues that Ian talked through on really having a better internet, but the fact that it's just so much more convenient, right? So, in the demo you saw, one of the institutions issues a credential, for one of their employees, through their, maybe a bank's local, IDAM, authorization, say, yes, this person has passed the Series 3, they're, able to trade on your exchange, from our compliance perspective. So, so a credential is issued, that they will be a trader on the exchange. It sits in their wallet, so they basically have private keys sitting on their phone, so that when they log in, exactly, who they are, or sorry, their permissions to be there and trade without having to centrally hold all of their data. Now, there will be obviously, regulatory requirements for accessing various, records and so forth, but that's also something we can do using this ID++ ecosystem being, interwoven in the whole technology stack. So, very, very quickly, someone can, use whether it's a video file or a voice file or trade chats. All of that can be bundled through ID++, identifiers of metadata. So when a trade is completed, all of that gets automatically held for both, internal compliance and external regulatory purposes. So this is really just a whole new paradigm for trading that not only makes it more secure, it's way easier to log in, no more login password, literally just look at your phone and scan a QR code and you're logged in with all the right credentials. So it's easier, it's safer, and ultimately we believe that will be a faster way to move to things like real-time clearing. Particularly as more and more firms are able to have, call it blockchain title transfer products, whether it's sovereign bond markets or central bank digital currencies. All of these things would be interoperable with our system really on day one, which is not the case for most other exchanges.
Yeah, it seems like financial institutions have so many different layers within them, and this technology allows you to disintermediate that so that it's much faster and secure, right?
Exactly.
And we just saw something with OpenSea over the weekend where they had some issues, and I know you're considering a NFT platform called Upboard potentially that was discussed in some of the regulatory filings. I'm not sure if you're able to share any updates on that.
Yeah, and so I guess one other thing I should say is we brought in a whole new sort of commercial and product team lead last fall. That are all not only obviously getting all of our technology into a commercial ready state, but they're also leading other commercial initiatives in looking at how we use this this fundamentally transformational technology in ID++. How do we use it in other markets? So one of the obvious use cases are auction markets. Not only do we have some of that sort of built in our own commodity exchange, but using that verified but anonymous login, where again the auction house isn't keeping the user's data, so the auction house can't call it rig, who's in more favor, the buyers or sellers, which you always see in auction houses. So we've seen some really interesting developments in auction methodologies in DeFi, and to bring that to real world goods is something that we're looking at. Again, just so we don't, really set back any of our main product timelines. Most of the design work is being done by third-party firms with Upboard. So we want to keep that ball rolling, so to speak, without bogging down any of our core team. And so, we'll almost like a side research and development project. But again, we think these use cases in markets are almost endless once you change the paradigm of the internet. So again, we want to make sure we're never distracting our core focus of getting our core features launched, but we want to make sure we're first to the land grab of how self-sovereign identity will change things. And maybe the final thing I'll say on that, there was an announcement by what are they called? Anyway, the consortium that between Coinbase and Circle Financial, that they issue the USDC stablecoin, and they've announced a new self-sovereign identity standards framework for the travel rule. So to have verifiable credentials, very much like ID++, it uses a very similar architecture. So there are now standards that are being developed, and I think Block, Square Crypto was also involved. So you're talking about 100 billion in market cap in this consortium for launching a new verifiable credentials standard for tracking KYC assets in a DeFi system. So again, this, and it's very similar to the architecture we believe in. So I think that's another point of validation that we've been on the right track, and that perhaps this world is sooner than we think, with getting personal information out of central application databases, and really just trading using verifiable credentials.
Thanks, Josh.
One other, while we're on the technology, sorry, I guess we're at the top of the hour, but I do want to mention on the technology side, both the risk and the opportunity. Part of moving our tech stack to a more Web3 native, we are continuing to modify some of our core infrastructure as well. So we're going to be tweaking and upgrading all the way to the point of launch. And so while we haven't expected technology to be core timeline issue for a while, I did want to disclose that once you launch an exchange, it's very, very hard to change your infrastructure. So we're going to be constantly tweaking and building the right infrastructure to have, again, that Web3 native, as also some machine learning native capabilities really from day one. So I guess with that, we'll obviously have more updates around after a big commercial push, and as we publish our audited annual financials at the end of March, and an updated AIF. So more disclosure to come over the next month. Thank you all for joining, and continue to any questions that we perhaps didn't answer, feel free to reach out through IR.